I'm Alan Kinney, Editorial Director with REIT.com, and we're at the Wynn Las Vegas for REITWorld 2015, NAREIT's annual convention for all things REIT. I'm joined by Lauralee Martin, President and CEO of HCP.
So Lauralee, we're here at REITWorld. Obviously you're meeting with lots of investors right now. Are there any issues or themes that keep kind of coming up consistently in these meetings?
I think investors are curious as to whether, with the changes in cost of capital for REITs and potentially the rise in interest rates, whether assets are going to reprice. Our cap rate's going to go up. And I would say it's a little early to make that call. We have seen some of the larger portfolios come to market and be pulled, so maybe that's an early sign that there are going to be adjustments to price. I'd like to see a little adjustment to price, but I think it's a little early to call.
And the amount of new supply of product in the healthcare sector and all the different segments has been pretty well documented, but are there any segments that you think might be undersupplied right now?
Well, we actually are seeing opportunities in two places. And again, we're a diversified healthcare portfolio, so we get to take advantage of that. One would be in the medical office area. We have several relationships with hospital systems that have built new acute care hospitals and want to have MOBs, medical office buildings, on campus surrounding those. So we're doing development with two systems right now, and we think those will be very good opportunities. And then the other one is in the life science space. We have our very exciting Cove development in South San Francisco, which is off to a great start. That market has less than 1% vacancy. Rental rates are rising very nicely as a owner of the assets, and we think there's going to be a lot of opportunity there.
And eventually the Federal Reserve is going to raise interest rates. How's that affecting your planning when it comes to the capital markets?
We've funded our business with a long-term look, really with all of our investments. So the majority of our debt is 10-year tenors in terms of maturity. That puts us in a very good place relative to our portfolio. And the few maturities we have coming up, in fact, we'll be able to refinance favorably to their current interest rates. So one of the things we like about our portfolio is not only do we have built-in organic growth, but it's funded such that it's a very protected organic growth for our investors.
Thank you so much for your time.
Thank you.
For more from REITWorld 2015, check out REIT.com.